When it comes to investment return, what do you think matters most? How much you earn or how much you get to keep after taxes? I think most of you would agree it's the latter. After all, it's your net income that you get to spend, save, or invest. In this course, you're going to learn about tax-sheltered plans and tax-saving strategies. To truly understand the benefits of tax planning, you need to have a general knowledge of the tax system. In this mini lesson, we will discuss the following: Canada's progressive tax system, the difference between marginal and effective tax rate, and a tip on when to use one over the other. For the purposes of this mini lesson, we're going to use the tax rate table you see on the screen. Before we start, I need to stress that these tiers and percentages are not deemed to be real-world accurate. I completely made them up using easy numbers for learning purposes. For example, in reality, the top tax rate in Canada applies to those that earn well over $200,000 per year. So be sure to focus on the concept I'm teaching, not the actual numbers or tiers. Canada has a progressive tiered tax system, which means as your income increases from one tier to the next, so does the percentage of income tax you pay. Have you ever heard someone complain, "I'm in a 50% tax bracket"? Well, this type of statement is often misunderstood. It does not mean that 50 cents of every dollar you earn goes to the government. Let's analyze our sample tax table together. Tier 1 indicates that the first $10,000 of income attracts 0% tax. With Tier 2, notice the phrase "on the portion of income" is used. Let's look at a simplified example. Kylie just started a job as a fully commissioned employee. Let's assume that in her first year, she earns $11,000. Again, I'm using relatively low numbers to make the learning easier. She would pay 0% tax on the first $10,000 of income and 25% on the next $1,000 she earned. With that in mind, let's calculate her total tax bill. $10,000 times 0% equals $0. $1,000 times 25% equals $250. The total tax, $250. Now, when it comes to tax rates, it's important to understand the difference between marginal and effective tax rates. The marginal tax rate is the rate of tax she would pay on her next dollar of income. In Kylie's case, her marginal tax rate is 25%. The effective tax rate is the average tax rate, calculated as follows: $250 total income tax paid divided by $11,000 income earned equals 2.27%. While Kylie's marginal tax rate is 25%, her effective tax rate is only 2.27%. So if you're in a 50% tax bracket, congratulations, you earn an impressive income. But also keep in mind that only a portion of your income would attract that tax rate, not your entire income. Now, if you're preparing for an exam, you may be wondering, how do I know when to use the marginal rate or the effective rate? Well, unless you're specifically being asked, what is the person's effective tax rate, you're almost always going to be using the marginal tax rate. Once again, the marginal tax rate is the income tax rate one would pay on their next dollar of income earned. For example, if you're being asked how much tax would be owed on $1,000 of interest, we would assume that is over and above the individual's other income. In other words, if you earned another $1,000, how much tax would you have to pay on it? Now, you could very well be asked to calculate the effective tax rate, but that would likely be a more direct question. It's also a good question, so I recommend you know how to do the calculation.